All right. So I want to welcome everybody here today to our webinar Wednesday. We have our speaker of the day is going to be Jim Weigel, and I'm going to be asking him a few questions to get our Q&A session started. But before we get started, I'd like to go over a few housekeeping items. Before we begin, I'm going to let you know that we are recording this session. So if you'd like to come back and revisit this session, you can go to our events section on our website and scroll down to watch this or any other webinar we've done in the last couple of years. You can also submit your questions anytime. At the bottom of your screen, you should see, you might have to click, pull down on your screen, but you should see two different chat bubbles. There's one that's for chat and there's one that is for Q&A. And if you click on the Q&A button, you should be able to ask your questions there. You can ask your questions throughout the webinar today. Normally we hold questions until the end, but because we're doing today's webinar in a different format, we will address questions as they come up. We are limited in time for the webinar today. It won't last longer than 11 a.m. So we will get to as many questions as possible. And of course, we always welcome your comments and suggestions. Our two speakers, like I mentioned before, are Jim. He specializes in helping home builders implement effective management systems with a focus on disciplined leadership and performance excellence to increase revenue. His areas of expertise include management, marketing, sales, finance, quality, valuation, owner transition, and he also is very knowledgeable on banking issues, which is why we're offering this webinar for today. Today's webinar, we're going to do questions and answers about banks, financing, and in a housing downturn. We will get started here in just a second, and I'm going to go ahead and stop sharing my screen so that you can see Jim and I. So I'm going to turn it over to Jim to kick us off.
Thanks, Jane, and thanks for all of you for spending an hour here. Hopefully, you'll be putting some questions together so we can address them. But I thought I'd just start out with what we're going to try and cover a little bit about banks and builders in what we are experiencing in a downturn right now. We are in the early stages of a downturn, so banks are probably just starting to get worked up about certain things. You will notice that they will tend to do irrational things and rational things. And we're going to talk about some of those today. The rational things break up into two categories. One is the rational things with you that you should be doing anyway to protect your profitability, your cash flow, and the longevity of your business so it can survive throughout this downturn. The other rational thing they do is really hard for builders to understand a lot of times, but it's rational from the bank standpoint because they will cut back on lending in certain areas and to certain industries. And that seems like it's irrational to us, but to them, it makes perfect sense if the regulators or the Securities and Exchange Commission or the stock market or their owners, if people feel like they're taking more risk in the real estate industry or the construction or land industry, then they will just cut off loans in that area, no matter how good the project or the builder. And then the irrational things are the things that they do that really aren't helpful to them as banks in the long run, and they can often destroy a building business. So we'll go through a few of those today with some questions that Emma Jane's going to ask me and we'll talk about. And please start putting your questions in as well so we can address them to the extent we can. Let me just give you a little bit of some rules or background. I was in the banking industry for over a decade, almost 15 years, in commercial banking, savings and loans in particular. Made loans to builders and all kinds of real estate, mainly throughout the Western US, but also throughout the US and internationally through participations we would do with other banks. Specialized a lot in real estate in various areas. Was also running a real estate owned and workout department for savings and loan here in primarily in Colorado assets, but also had others in surrounding states in the late 80s. And so I've learned a lot about the banking industry, both as being a banker, but then as a builder, worked with banks quite a bit, buying properties from them, worked with builders over the past 20 years, working with Chuck and Emma, helping them get through some downturns, especially the 2006 through 2012 debacle that we all endured, and helped a lot of our clients work with their banks as well. I still keep in touch with a lot of bankers, although most of them that I know have retired. I'm working with some in the next generation, and many of them have never experienced a downturn. So this is a new thing for bankers as well as many builders. Just to set the stage, the current prime rate is 6.25%. The current mortgage rate is for the average borrower right now is about 7.7%, and these are about double where they were this time last year. That is causing a big ruckus in the banking world as well as in the home building world. So with that, Emma Jane, feel free to start with some of the questions.
All right. Well, just real quick, I noticed that the Q&A chat bubbles are not on the bottom, so submit all your questions through the chat bubble, and I will answer questions through there. But our first question, and this is Chuck's favorite term, cash is king. So he's always talking about how important cash is. What does that really mean to a builder as we look into the future?
Well, we really want builders to build up their cash position, and that means making sure that you're not taking actions that decrease your cash. So we want you to start closing more homes than you're starting. That tends to generate more cash, or at least keep the closings and the start pace similar. We want you to be careful in buying a lot of land, and then most particularly be very careful with your fixed overhead and make sure that it's staying balanced with what your sales volume is. So when you have cash, you've got flexibility to do all kinds of things with your business and with your banks. Now, banks become schizophrenic when it comes to cash. They want you to have positive cash flow, and many banks will even look at your cash from one year to the next, and they want to see it grow. So they want you to have cash on the one hand. On the other hand, if they see that you want to extend a loan, for example, a loan extension to extend the maturity of a loan, they may say, well, you've got cash on your balance sheet, just pay us off. So they may want some of that cash. At the same time, they want you to increase the cash. So they're going to be contradictory at times. So we've got to be able to tell them a good story as to what you're doing with your cash flow, why their loan is not in trouble, why it's safe, it's certain to be repaid, how you're going to handle different situations that come up. The other thing with cash to be careful of is you want to guard against irrational things that banks can do. So they may take your cash if they have the right to. So you want to go read all of your loan documents, your construction loan agreement, your note, promissory note and deed of trust or mortgage, and see if they have a right of offset, which they often do. That means they can take whatever assets you have at your bank and use it to apply it against your loan, and that's okay. You've already agreed to that. So with everything I'm saying here, you're going to want to go find a good attorney so that you can talk to that attorney about what the risks are in your loan documents and how that can affect things. I'm not an attorney, so anything I say, you need to go discuss with your attorney and make sure that it's correct for your state and your situation with the bank. But be very careful about how much cash you keep in the bank that's titled in the exact same name as the borrower.
Yeah, Jim, should I have more banks than one bank, and should I put the cash someplace else?
Well, you want to be very careful with that. You got to communicate with your banks Sometimes it's better to have the cash in a different bank. It might be best to title it in a different entity. So do some estate planning, maybe create an LLC or limited partnership so that it's got some dry powder to go buy land and take care of things. But this is where you want to be very careful in moving cash around, especially in large amounts from one place to another, because you might just trigger the bank to be panicked if you're taking a lot of cash out of their bank right away. So you want to have good communications with your bankers all the time, so those communications are very clear, is that the bank is protected at all times and they know what you're doing, and that what you're doing is prudent business and protects their loan.
Jim, should I allow the bank to do sweep accounts?
Generally not. Most people are not doing that these days. Some of the larger banks and the larger builders may have sweep accounts where they take all of the cash from each closing, apply it to the loan. It's a really good idea because it saves you interest, and the interest rate you have right now, if prime is 6.25, you're probably paying 1.5 over prime. So you're probably paying 6 3/4% interest. So it makes sense from a profitability standpoint to have a sweep account that takes the cash and applies it to the loan. But just realize now you have no cash at that bank. It's all paid down the loan, and they don't have to give you those loan proceeds back if they accept under the terms of the construction loan agreement. So that's why you want to be very careful so that not all of your cash flow is tied up in a sweep account, that you've got at least some cash flow outside of a sweep account, and that you've consulted with your attorney and read those loan documents very carefully, and that you understand the risks of the sweep account as well as the benefits.
Okay, next question. Do you have any more questions you want to tack on to that first one, Chuck? I think he's done. All right.
Okay.
Second question that we have to get our webinar going is, should I reevaluate my inventory as it relates to finished homes or specs and models? What do I need to consider when I'm doing that?
A few things. First of all, you're probably all starting to experience some reluctance, at the very least, on the part of lenders to finance new specs. They probably want to see a lot more pre-sales, or they want to see you sell a home before they do a new spec. They're trying to be very careful on spec inventory. In fact, some banks are even saying, no, we don't want to do it at all. So I'm expecting many of you are starting to experience that. The other thing is, if you have a spec home and it's now a finished home, banks are going to be very interested, and they're going to be asking you a lot of questions as to how long it's going to take you to sell it, what really is the value of that home, what's the accounts payable on it, what's the deposits, etc. Because they want to make sure that they've got clear collateral position on that home, and that you're doing all that's necessary to sell it. At the same time, they want to make sure that it's going to sell within the maturity of their loan, so that they don't have to extend it. Or if they do have to extend it, they're probably going to want you to pay down the loan, at least partially. Sometimes they call that a curtailment, where they may want you to pay it off in full. This is where it's going to be very important to talk to your lenders and communicate with them regularly and clearly and simply. We don't want to tell them everything that's going on that you're worried about, because you do not want the banks to get all worried as well. They're going to take whatever worry you have and they're going to magnify it 5 times. So you want to be very clear in what you're requesting from banks on spec loans. They're also going to be looking at your inventory of pre-sale homes to make sure that if it's close to finished, that buyer is going to close, that their mortgage they still qualify for. They're very concerned about anything that's getting close to finished, because once it's finished, the interest costs and the loan balance are at their highest amounts. And so their exposure is at the highest risk at that finished inventory, and your carrying costs obviously are at the highest point as well. So you just want to be careful you're not starting too many specs, and then they all of a sudden start piling up once they're finished. And now you have to do a lot of discounting, and that start affecting your appraised value. So the bank's going to want you to cut back on all of the loan amounts. And they're going to want to know a lot more about your competitors. If your competitors are discounting in the same area, so you're going to have a lot more communication that you need to do with your banks. So one of the things that we suggest is you start exploring ways of selling off your models, because they're your most expensive carrying costs, to investors, and leasing them back, or maybe setting up a loan facility through a private partnership that you set up, where you buy the finished homes from yourself, put it in that partnership, and pay an interest rate to people who would enjoy a 7 or 8 or 9 or even 10 or 12% interest rate, depending on the risk and what you can negotiate, because they're not getting more than 2.5 or 3.5% from the bank on their savings and CDs either. So this is a great opportunity to go set up some other financing vehicles where you can help out your customers, your banks, and show them that you're going to pay off the loan when it becomes due, and you're going to be a good borrower because you've got the resources to do that. There's a couple other things that we want to do, mainly to make sure that we're only starting spec homes that actually are profitable and people want to own. People have been building all kinds of homes over the past couple of years, and the prices have been going up a lot, but they aren't necessarily profitable. And now they're going to have to get those prices corrected to price to the market properly.
Excellent. Thank you, Jim. Chuck, did you have anything you wanted to add as well?
No, I'm fine.
Okay.
We need to get to some of the other questions if we have questions.
Well, apparently the chat's not working properly. So if you do have a question, raise your hand, or so Julie Olson has a question. She's going to wait till the end. Well, you can raise your hand, or you can email me, and I put my email in the chat so you can send me your question. So the third question we have here is, as a builder, what do I need to consider when I look at my land position?
Well, the key thing right now is land prices are really high and sales are dropping. So they also require a lot of cash. Lenders are probably going to be more reluctant to advance anything or as much on land. So the key thing is have a very good land acquisition process and due diligence, so that you know that when you buy land, you're buying at the right price and you can make money on that piece of land over the next year to 2 years. Make sure that you're paying it. The cash isn't going to impact your cash balances severely. If you really need that land, you've got the sales in front of you. You're going to produce profitable homes on that land, and make sure that you've got plenty of equity to buy that land, because lenders are going to be more interested in land deals where there's a higher proportion of equity in them these days, just as they're going to be interested in financing spec homes with a higher proportion of equity in it than debt as well. This is also a great time to start looking for financing sources outside of traditional banks to help buy the land. But the key thing right now is be careful about buying too much land right now, or even any land at current prices, because if the sales prices of your homes are going down, then the land price is going to have to go down somewhat. Otherwise, it won't be feasible to build on that property. The thing to remember, especially about land, is land values increase faster than home values, both going up and going down. So now we're going down. It's going to take landowners some time to realize that their land value is also going down, but it's going down at a much faster rate than the home values are going down. In fact, in a few months, if home prices keep going down and sales volume keeps going down, many pieces of land won't be worth anything to buy for a while. And so those landowners will just have to sit on it for a while until it makes sense to build homes again.
Yeah, and
Now,
land,
go
and
ahead,
land
Chuck.
values tend to be sticky too. And they tend to drop at the end of a cycle. And we're at the beginning of the cycle.
Yeah, this becomes a great place for you to become a trusted customer of your bank, so that you know how to build on land, you build profitably, you do a great job, you service your customers, you take care of them, all the things we've talked about as being a good builder. Because if they see that you're a good customer and you have some cash and you have access to other cash and debt, you're going to be one of the first people that they want to talk to about buying the land that becomes a problem on their balance sheet. So you're going to want to start talking with the special asset folks, with the other people in the bank who are going to start seeing more of these problem deals and see if you can help them out through those deals as well.
And Jim, you were there. There's an opportunity before it goes into foreclosure, typically for me to come in and buy it from the current borrower at a really good price without having to go through the foreclosure process.
Yeah, in fact, you'll probably see less of it. They're probably going to sell the loan to someone before they even get to a foreclosure process, because there's a lot of people competing for these distressed debt deals anymore. So you want to be in front of that so that you can, cut a deal. And the deals are going to be very different these days. That they'll require some sort of cash, and they're going to require expertise in building. So you want to make sure you're in front of those folks way before it gets to foreclosure time.
All right, excellent. Our final question, and then we're going to open it up to anybody else who has questions. If you were to go visit a builder, what would you need to see to help them make a plan moving forward during these uncertain times?
Well, we have a checklist of between 12 and 20 items that we need to look at with a builder to understand where they are, where they have been, and where they are going. And that checklist includes things like financial statements, a list of the floor plans they are selling, some job cost reports on those. And then we add into that things that are peculiar to the banks, like what is the bank's draw request process, what's the construction loan agreement, et cetera. And we're also trying to see, these days, we've communicated so much with people via email that a lot of times we're sending information to the lenders from all kinds of different people at our company. It's not controlled. It is not clear, and sometimes it's counterproductive. So I'm not even talking about from a legal standpoint that you want to be careful what you tell your lenders so that you don't get yourself in too much trouble. That's something to talk about with your attorney. What I'm talking about is you don't need to tell a whole story of what's going on with your potential customer as to why you need an extension of the loan. Just tell them, here's what I want my extension for, this amount of money I'm going to pay it down, and this loan fee, and I need a 6-month extension or 3-month so that I can sell it. You don't have to go into a huge story. So that's another thing that we're trying to look at is your email communications and the meetings that you have, because you want to create a story with the bank and a regular set of communications that's based on your business plan. The good thing is that most of the things you can do for your bank's relationship, 90% of them improve your business. So what you want to be doing is having a really solid business plan going forward that tells you, here's how I'm going to run the business in the expected case. Here's if sales and prices drop. Here's if sales and prices go up. Here's what I'm going to do with overhead. Here's what I'm going to do as far as projections and budget for monthly income statement and balance sheet. Here's the actions we're going to take. Because the more you're controlling your business, the more comfort that the bank has that you're going to stay in business and protect their loans. So that's the kind of planning that we're trying to see, is deal with what we know is going on right now, and then project out some plans in case it goes down or it goes up from here. That's how we handle things in uncertainty. So those are just a few of the documents that I look at with our clients to help them run their businesses better, which also causes them to be a better credit risk to the bank. The other thing we have to start adding into our business planning is way more regular communications with the banks and the senior folks at the banks, and going to see the banks so that you see what's going on with them as well. Because you need to start doing due diligence on the banks. We need to get their financial statements, see what's going on with their loan losses and their assets, so that you can start understanding the pressures that your banker is under as well. So that's a few of the additional things that we start paying attention to these days to develop a good game plan.
Jim, based on that, Chuck has been talking, and he's very concerned about what's going on in the economy and where things are going. What would you say to somebody who is like, well, I don't know, I don't think all that's true, I'm going to just kind of best? What would you say to that person that's kind of wearing rose-colored glasses to make sure that they're prepared for both? Maybe it doesn't happen, or maybe it does. Well, how would you talk to someone in that manner with that?
I'm not going to say, I'm going to use an example of one client who does not have rose-colored glasses at all. It's just that their sales have been fairly strong still. They're in a good market. They've seen their cancellation rate double, but that's okay because they still have a strong waiting list. So they're not seeing their closings suffer at all. But what they're doing is they have kind of this productive paranoia. It's not like it's awful where they're just crazy or frozen. What they're doing is saying, what do we need to do next to stay ahead of the curve? And what I say for people is, it's not so much rose-colored glasses, but how can you prepare your company so that you can increase your market share as the market is going down? The partner I had when I started in the home building business, he'd always made more money in an economic downturn and sold more homes than he did in when times were great. And the reason why is because he just had great relationships with trades. And so we had great relationships with trades. We improved the feasibility of our homes, made them more attractive to our customers. We actually did the warranty, did the walkthroughs with the homeowner orientations, and made sure that the house was all ready. And we weren't panicking and discounting all the time like some builders are. So if you show that you're taking care of your customers and giving them a good value for the homes, you can actually come out of this with a higher market share. So I think, but part of it is kind of a natural human reaction where, yeah, let's just see. Let's wait a couple months. It's been summer, and sales normally slow down in summertime, and now it's the fall, and yeah, interest rates have gone up, but my customers still like us. So it's people just tend to find reasons why not to do anything. So what I encourage you to do is create some measurements. What's your traffic? What's your contracts? What's your cancellation rate? What's your backlog? What's your closings? And track those for the past 3 to 12 months and compare those things. And are they going up or going down? Is there any kind of consistency to that? And then just ask yourself, other than running out of cash, which will obviously stop your business, when would I make some decisions? Well, if those numbers look like something, when would it trigger me to make a decision so that I don't run out of business? That's what's tended to over the years help our clients understand that, yeah, things are different, and maybe they'll get better. Maybe things will turn around in 3 months. I don't know the future, but what if it doesn't? What are you going to do? That's what we're trying to figure out, is what's your action plan both directions? Does that help answer your question, Emma Jane? Or
I think so. Yeah, I think that's great. I think that it's important to be prepared. And I with the discussions that we've been having, I'm hoping that everybody's able to prepare for future.
Mhm.
All right, so I know that Julie does have a question. So Julie, if you'll raise your hand so I can find you easily on the list, go ahead and click the raise your hand button and I can let you, there you go. I'm gonna allow you to talk, to ask your question. And so if anybody else wants to ask a question, you can raise your hand and I'll allow you to ask your question live. Go ahead, Julie.
Good morning. Can you hear me?
Yes, we can hear you.
Super. Okay, so I have a question kind of on the cash flow side of it. We're really good on cash right now. We have not drawn on a lot of our construction loans. We're just using our own cash to continue to build. But our sales recently are really, really poor. So I know 9 months from now, I'm going to be in a really bad position potentially. So we've been trying to work with investors to do some of our A&D rather than relying on banks. Well, I already had gotten an A&D loan from one of my banks on a track that's going to start in January. We're doing like the development now, but it will start selling in January. So I don't really, he has an extra $1 million to give us and I don't really need it. But then I've had really bad sales recently and I almost anticipate it to continue to go bad. Do I go ahead and accept that loan from him and know that I'm going to basically be incurring interest with him for a year in which I don't really need the cash? And then we kind of feel like if we don't take his cash now, we don't take that loan now, it probably is not going to be available 12 months from now because he's an investor who invests in like a lot of different businesses. So, the cost of the loan is probably prime plus 1.5 maybe. But then at least it's almost like having a rainy day fund, but it's costing you money. What's your thoughts on that? Should we borrow that money from him? And the bank knows it's not like the bank had already funded us, but they're okay with us also getting invested money. And I'm just afraid the way we pay this person back is we pay them upon close of escrow of every lot. So when those lots that we're going to associate with his loan start closing, they're just going to generate less and less cash flow from us down the road. So it's almost like I'm borrowing money for just in case, and then I'm going to get less money out. My gut says don't borrow it from him, but I kind of wanted to get your perspective.
Well, you're asking a question, Julie, that I would want to look at a lot of other information about before I give you a recommendation.
Okay.
So I'm gonna give you some ideas on that. But first of all, we want to look at what your current balance sheet position is and what your current income statement is for the past 3 months or so. And then we want to look at your projections over the life of your land deals. So I'm going to say that's 1 to 3 years, and quarterly is fine. And we want to look at, all right, here's if sales continue at the current pace, here's if they get worse, here's if they get better. And then we're going to look at a few different scenarios as to what happens to your cash under each of those scenarios. And if your cash is okay under each of those scenarios, then I would say don't take the loan. You don't need it. But my gut would tell me that, first of all, you want to look at your cheapest source of cash as well is your construction loans. A lot of times, if you're not using, if you're not borrowing on your construction loans, those will normally be a cheaper source of cash than a land loan. So that's something that you might want to look at, is just change your policy and borrow some more on your construction loans, because those construction loans will always pay off when you close the sale of the home, and it'll always be less. It will usually be less costly than a land loan, and almost always less costly than some sort of investor. On the other hand, though, you know, we are really pushing people to get more cash than you think you need right now, that you can even imagine needing right now, because it gives you more flexibility. The problem is that now we're not back to the early 80s yet, where interest rates were 18 to 21%, but we're almost halfway there, right? So the cost of liquidity, the cost of cash is now expensive. It was not expensive a year or two ago. You know, interest rates were half as much. So we didn't really, it didn't really enter into our mind as the cost of cash, the cost of being liquid. But I would encourage people right now to, if you can get more cash on a reasonable deal that you believe you can pay off under the normal course of business, or if things get worse, then I would get some more cash right now, because you can always pay it off and reduce that interest cost. And I would keep getting sources of cash as much as you can. First of all, because it gives you some flexibility, and it gives you some dry powder in case you start seeing some good deals that will come up. Now, getting it right now is not ideal. The good deals aren't going to be here for a while, and you're going to be paying interest on that for a while. So I would really look at that sales pace and your projections, and do a bunch of scenario planning, which is exactly what I would do before I give you a really solid recommendation. So I've tried to go around the horn as to what the possibilities might be for you to consider in this answer. And I'm sorry it's not as black and white as I would like, but I can't really give that black and white answer until going through that scenario planning.
No, actually, that's very helpful. It will at least get me starting thinking about looking at it 2 to 3 years out and looking at our entire pipeline. So that is very useful. My second question, if I could ask, is you had talked about, you said guard against banks, and one of the things you said is they could, can they have a right to offset, and they'll take your cash and apply it to your loan? In what situations do you really usually see the bank do that?
It's like, what I understand is heart attacks. 50% of people have heart attacks, and the first one they have is the one that kills them. And the reason I'm paying attention to that is because, okay, I'm in my 60s, so people I know have heart attacks. Well, the reason why I say that with a bank is the first time you won't know. There won't be any sign. There won't be any sign that bank is going to take your cash. It'll be a complete surprise.
Right.
So I wish I could tell you that there are signs. And I don't know what they are, though. A bank does, I mean, 99% of the situations they won't do it. They're going to try and talk with you. They don't want to get sued because they've closed down a profitable business. But if that banker believes that that's the best way to get repaid, and they're willing to to go fight in court for years about it, they'll do it. So you want to see who's really making the decisions at that bank. And you also just want to realize if it this is one of those things, it's like an earthquake. If it happens, am I willing to lose my house? The odds of it happening are tiny, at least in Colorado. Maybe in California it's different. But people here in Colorado, the odds of a fire were non-existent if you lived in the prairies. The fires happened in the mountains. And then New Year's Eve, a year and a half ago, whatever that was, we had one of the hugest fires ever and destroyed hundreds of homes because the wind came up and no one believed it would ever happen. So this is not something that has what's the predictable chance of it happening? It's just, if it happens and all of your cash is in one place, are you okay with it going away?
Yeah,
Now,
if go ahead.
I would say the exact same thing. People should pay attention to this just for deposit insurance. What if you've got more than $250,000 at a bank, it's not insured anymore. So if that bank fails, then you lose. So I would do it. It's the exact same thing. You're trying to protect your cash from failure. So I hope that helps. I could keep going, but I better stop.
If like one of our banks, we have probably 10 different entities with that specific bank. And so we do spread our cash over the various entities. Can they take from all entities and apply it to one entity's loan, or it has to be in the same entity?
Well, there's a legal and a practical part of that question. Go talk to your attorney and look at the construction loan documents and guarantees, because it could be that legally they can do that. They can do that with any entity legally. The other thing, practical.
What they will do is cross-collateralize all those entities.
A lot of times that's true. The other thing is, even if it isn't legal for them, they can do it. If it's in their bank, they can do it. And then they'll just fight about the legality of it over time. So that's why I'm just saying, if your cash is in that bank, just go through the scenario. How would our business work if it all went away?
Okay.
And if you're okay with that scenario, then don't worry about anything I'm talking about.
Thank you.
Sure.
Hey, Julie, just one thing. You mentioned the fact that you've been not drawing on your construction loans. And if your sales are going down, you're going to be closing more houses than you're starting. So you should be able to solve your cash flow problems in that way, and then starting to use your construction loans.
Correct. That's the plan. And I see that happening probably Q1 or Q2 of next year. I mean, it's not like we don't use any of the construction loans, but we use very little. So I think we're going to be cash rich for a little bit, but then depending on how long this lasts, you can only sustain so long.
Yeah, this could last a long time.
I've got some clients who they're having some of the best year ever. They're closing most closings, most profitability, most cash flow, but then their sales are not very high.
That's us.
So this is going to be an issue where we're feeling awfully good, but you have to make your plans not just for where we are right now, but where that puck is going to be, right? So what's your current sales pace? What do you think it's going to be? And then what kind of fixed operating expenses do you want to have to hold on to that, to operate and to improve your business? I'm not saying cut everybody on the staff, that you might be able to apply some of those folks to improving the profitability of your homes, improving customer service, improving your processes, et cetera. But how much of your cash do you want to devote to those kinds of long-term business planning activities. That's what we want to look at in your forward projections.
Thank you.
Sure.
All right, we do have someone else who is brave enough to raise their hand, so I'm going to go ahead and allow them to talk. Go ahead. Just make sure you unmute yourself. There you go.
Thanks, Emma-Jean. I appreciate it. Can you hear me okay?
We can hear you.
Thanks to Jim too for the Gretzky reference for going to where the puck's going, not where it is. Appreciate that. We're in the same boat, a little bit different than what Julie is. We're actually looking to possibly make some development loans to some local builders in our area. We've got plenty of cash to do that. Two questions from a banking perspective. You know, currently, what level of loan do you think would be prudent? You know, we're thinking somewhere between maybe 40 to 50% land value, but with land values probably going to be declining significantly in the next 6 to 9 months. A little concerned whether or not 50% might be too high. And also, what steps do you think we should do other than the traditional banking inquiries about monitoring the progress of a lot and a home, doing some routine inspections? Anything else you think we should be doing from a private lender standpoint?
This is great. So you're actually going to be the land lender. Is that what I understand?
Yes, sir. Hopefully we'll do deals probably in 2 tiers. We've got some where we think we have some opportunities to land on developments that we could actually step in if we had to foreclose and complete the deals. And we've got some others, 1 or 2, where we wouldn't be interested in doing that. So we probably would be looking to lend a little bit less on a percentage basis against the value of the land.
Okay, so the first thing is you and your customer are going to have to do awesome due diligence on the land and the market. And that especially means the market. So what are we really going to sell the houses for? What are they really going to build the houses for as far as cost? So you're basically, you need to underwrite that builder to make sure that builder is building homes profitably.
Right.
Most lenders do not pay any attention to that. And so they just run into a wall and say, okay, now what do I do? That's so what I would suggest is evaluate builders according to how well they do on the Shin method. That was one of my successes as a lender back in the 80s. I actually had some criteria I used for home builders because I got them from Lee Evans and Chuck and Emma. And I never had any home builder loans go bad, ever. And I never had any land loans go bad, ever. Even though it was just a pain in the butt working with regulators and everybody else. So, but that's a lot of work. So you got to go underwrite those folks and make sure they are doing the home building business properly, and that the costs that they have for those homes are actually going to produce profit at the land value that you need to pay off your loan and keep them interested in it. The other thing, if you're going to be a lender, you better find some alternative sources of cash flow if they're going to guarantee that loan to you. So if that builder is guaranteeing the loan to you, you better figure out that they've got other sources of cash or cash flow to help support that guarantee. Because if that guarantee solely relies on their business paying you off, then that's all you got. The other key thing is really when you're underwriting these loans as a land lender, you're buying it at that price. So if you're doing a 50% loan to cost, then you've just bought that property at 50%. And if you're okay with that for the long run, and you've got really good attorneys on your side so you can control it and get control of it if they're in default, then you're great. But you're going to have loan covenants where they have to pay down the loan if the value of the land declines. You're going to have appraisal requirements that you're going to do almost any time in case the market is dropping. Those are the things that you're going to want to add into your monitoring. Now you have to decide if that's worth it to you. Because it's a lot. It's a lot of work.
It is a lot. That's why we're giving it serious thought. Yeah, it's good points.
All right. Does anybody, we have a few more minutes. Does anybody else want to ask a question? Give you a second. Okay. I apologize for the chat not working. I'm not sure what happened on that front. But
Maybe you could check with them a little, Emma Jane. How many people are having trouble with spec loans? Are you able, is everybody able to start as many specs as you want and get them financed by the bank?
they
All
can't
that
even
work.
use the chat, unfortunately. I'm not sure
okay.
what happened with the settings on the
Or just
webinar.
just raise your hand.
Yep, just raise your hand if you're, yep,
if
go
you're having
ahead.
trouble.
So it looks like we have quite a few. We have 4 people that raised their hand for that.
Okay, so let's just talk about spec loans for bid. Is first of all, the bank may be right. Let's consider that side. Maybe we really shouldn't be starting as many spec homes as we used to. So that from that perspective, think about that to make sure that you really need to start those spec homes. And if you really believe you do, see if you can talk to the bank about just doing a lower loan amount. So maybe they'll lend 75% of cost rather than 75% of value like it used to be. See if that will work. And then if you can get some money or you can get some investor money to put into it, then see what the spec limit is. Now, this is assuming that the specs that you start really are profitable homes. So make sure that those homes truly are producing the profit at the current market value based on the sales prices of existing homes and competitive homes for that home. So make sure it truly is a profitable home. And then if you got other issues regarding spec homes, feel free to call us.
I do have Kelsey with a question, it looks like. So I'm going to go ahead and allow you to talk, Kelsey. Just make sure you unmute yourself and you can ask your question. Oh, she took her hand down. So she must not have a question.
Okay.
All right, Kelsey. Anyway, all right. And did you guys have any more questions at Dragus?
No, I'm good, Emma Jane. Thanks very much.
All right, thank you. All right, well, Julie.
Is anybody
Julie has
having
another
trouble
question.
getting
has
finished lot
another.
loans or development loans? Anybody on that?
Hey, Jim, one of the things on value.
Yeah.
The public builders were buying down loans, doing closing costs, doing long-term locks, and buying down loans. And they weren't discounting their houses up until about a month ago.
Mm-hmm.
Over the last month, they've been discounting substantially on their loans. And so when you talk about what is the value, I think you need to pay attention to the fact that all of a sudden we're starting to see a lot of discounting. The other thing is the public's already have got their memorandum ready to go to the trades to say, as of the receipt of this memorandum or this letter, your contract with us is 10% less than what it was before the letter. And I've talked to a number of public builders. They said they've already drafted the letter, but they haven't sent it yet. So just be aware of some of the things that are going on when you start looking at what is the value of a spec at this point.
Yeah, let me take it in reverse order. So that letter, you can go start talking to other trades right now. And if they're working with public builders, they're going to be ready to start working with you if they get that 10% reduction. And usually those are retroactive, and that really pisses people off. So go talk with your trades, because you're going to be able to start getting a lot better deals on your materials and labor costs.
And the other thing is that the trades haven't experienced it yet.
No,
They're still working on your backlog, so they don't know that we're in trouble.
no, they're just starting to feel it. It's gonna be accelerating. So every month, go talk to more trades. And then on the first part, if you're paying anything towards closing costs or points, it's going to show up in a reduced value if they're doing the appraisals correctly. The problem is the appraisers are always 3 months behind on valuation. So you got to go watch what really is happening with discounting and loans and locks and closing costs, et cetera. Because that's going to tell you what the correct value is for the home. So we've got to go do a lot more research of the current closings this month. What did people actually pay, and talk with them and see if you can see what other things, incentives did they get to close that home, not just yours, but I would say go talk to the existing home buyers, because there's way more of them and you can get a better sense of where the price is going on the value. Sometimes you can get it from your key competitors as well. The other thing is people are not discounting homes as much that haven't started. They're either not accepting the contract or they're okay with it. Where the big discounts happen are those spec homes that are finished, or those homes that are finished where the contract got canceled. That's where they're discounting a lot.
Right.
So I think that stuff's going to be more temporary. So as long as we have a bunch of finished homes that are on the market, we're going to continue to have discounting. If there aren't a lot of finished homes on the market, the price is going to be set more based on what's going on with interest rates and construction costs.
I have 3 more questions. One, Julie has a question about specs, but I had someone text in. They wanted to know, how long do you estimate the economic downturn to last?
If I knew the answer to that, you should not believe me. That's because no human being knows the answer to that. So what I would suggest you do is be prepared every quarter and every month. What if it goes up from here or down from here? What do I do? You are actually, the reason why I say that is the traffic you get, the contracts you get, the cancellations you experience, those are leading the US economy. Our industry is leading the way to what's going on with the economy. So when you start seeing better stuff, then that's going to start being the sign that the economy is getting better. So I would say, look to your own information, look to your local builders' information, look to what's going on with permits and sales in your local area, in your price range, and that will answer the question. Once you've got about 3 months, 1 to 3 months of uptick on those things, you can be pretty confident that things are getting better. Does that help? I hope.
Chuck, did you have anything you want to add?
Yeah, I would. Minimum of 18 to 24 months. Typical cycle is going to carry you for about 30 months, 36 months. And looking at all the cycles that we've gone through. So, and with the radical position of trying to gain control of inflation, and the the federal government or the administration is still fueling the fire, and we're just dealing with the Fed trying to slow the economy down. He's only basically got 2 tools: raise interest rates, and he's going to continue raising interest rates through at least the first half of next year. So the builders that think they're building specs for the next building season, they're building specs for discounting. The next building season is not going to be very pretty.
Yeah, and I would say, Chuck, something that is not, I would be curious what your opinion is, something that's not publicized very much is the fact that quantitative tightening is now existing. And so the Fed was buying pretty much all of the mortgage-backed securities, all the mortgages that were issued in the country, the Fed was buying for the past 10 to 15 years. Now they are not doing that anymore. So now actual insurance companies and pension plans and other big companies are back to buying our mortgages. And they're going to require an interest rate on it that is probably in the 7 to 9% range if inflation stays even under 6. So those folks are really looking, they're going to be the source of buying mortgages. And we're not, our interest rates aren't there where they're very attractive to them yet.
Yeah, and the Fed is just getting started liquidating,
Yep.
and it's substantial liquidating.
So Chuck has a better sense. So if it's 18 to 24 months, that's great. So what that's telling me is the next year or two, your business plans need to be fairly low and be ready to go even lower, and then at some point be ready to go up. Be ready on all three scenarios.
Well, one of the things that you read between the lines, but one of the things that is happening is that the interest rate needs to go above the inflation rate.
Yep.
And we're only about halfway there.
Yeah, I mean,
Okay.
if things go back to normal, the prime rate should be, rather than 6.25 right now, it should be approximately 10.25 is what the prime rate should be right now.
Right.
And mortgage rates should be approximately 11.5 right now.
Okay, we have 3 more questions. We're a minute over, so we'll go ahead and take these last 3 questions. So those of you that are able to, oh, well, one question went away. So if you guys are able to hang tight for the next 2 questions, we'll go ahead and get those answered. Julie, go ahead.
Okay, on the issue of specs, I wasn't really clear because what Chuck had just said, it sounds like we're building them for to discount. So that makes me think we don't want to start them. In our economy, in our region, people want to buy houses like immediately and they don't want to build out because they're afraid of where the interest is going to go. And so they want homes that are going to be ready. So our thought was, okay, let's build a few more specs. Is that what you're saying? And based on what Chuck just said, it sounds like we don't want to build specs. And just if people cancel, that is your spec.
How many specs do you have right now?
We probably only have 4. Our banks don't allow us to build a ton. We could have 8. And so we were going to go up to 8 and possibly ask the bank if we could do more.
Well, if you go to 8, then when you sell one, you start one. Figure out what your limit is, where you feel comfortable with the specs. And then you just replace.
Okay.
And that's fine. But if 8 is what you feel comfortable with, go to 8. And as you sell one, you start one, sell one, start one, and stay right there about that 8. And you'll be okay. The problem is I've got a lot of builders that are going crazy since their sales have dried up. They're building a ton of specs. I was at the board of directors meeting for Denver. I'm part of the board. And every one of the builders said their sales have dried up, but they're building for spec for the next building season. I just sat there and shook my head. That's not the program. What you want to do is you want to have a controlled amount of specs. Maybe you go to each one of the communities and say, this is the minimum, this is the maximum number of specs I want to have in each one of my community. You get a cancellation that adds to a spec. You get a sale, I can start another spec. But and the 2008 period of time, I had builders that went for months with negative sales.
Yep, because of cancellations. So Julie, set your policy as to how many specs do we want to have relative to how many sales. So if it's 50-50, there's your policy. If it's 1/3 specs for every sales, then that's your policy. Just and start adjusting it that way. Make sure that every spec you start though is a profitable home based on the current market price of that home. Make sure that that's true.
Excellent. Thanks, Julie. Thanks, Jim. Last question, John, go ahead.
Okay, so we've actually been meeting with some of our trades trying to get costs to come down. And, like for example, our framer, he laid off about 60% of his labor force because he's feeling it dramatically already. Whereas windows, I can't think of another example off the top of my head, but we met with them and they're kind of in a sense understanding. Maybe they're feeling it, maybe they're not. They're hearing and seeing it, but their manufacturers and suppliers are still raising prices. And so they're like, I have no way to even help you at all because I'm fighting them to keep my current pricing. So I guess maybe we're just too early to ask for discounts, but any suggestions? And you said meet with them regularly, and we'll definitely do that, but we're trying to get costs down immediately and not getting much relief.
Well, you might get a little bit of cost break on the labor, a little bit on the materials if they're desperate. But the odds are that those prices are also sticky. The labor rates and the material costs, they're not going to be going down, really. They're just not going to keep going up as fast, is what we're counting on. So what I would look for isn't so much that they're discounting their unit costs, but what you're trying to do is reduce the waste with them. So now go through, make sure that the way they're framing is the least wasteful way possible. Make sure that the features you have in that house, the buyer is actually paying for at your margin, or you're discounting it. So really, it's now talking with the trades, spending time with them to get rid of waste that's visible, and also the invisible waste, which is really the waste where the buyer really isn't paying for it. They're discounting it. That takes some time, John. So that's where I'm going to suggest is the best way to start reducing your costs, because we're not, unless someone's just desperate for work right now and they're willing to take lower per day, and we're not going to get a whole lot of discounting on the labor side. And I don't think that's going to happen until there's way more unemployment in the rest of the economy.
Thanks.
Sure.
All right. Well, I think that's it for all of our questions today. I want to thank you all for joining us. Jim, thank you so much. I hope that the information we were able to share with all of you today was helpful, and that you're able to take this information away and start formulating plans to get through the next few months, or 18 to 24 months, as Chuck has put it. But we want you to know that we're here for you. If you need anything, please feel free to call us. We offer a bunch of different services to help you, ranging from our builder partnerships rebate program, training online, and live courses. We have our seminars coming up, consulting and coaching, data transfer with ECI Marks, MyTech, and COVA, and surveys. So if you are interested in doing a builder of choice survey, making sure that you're building your relationships properly with your trades, we do the surveys as well. And then we have builder groups, which I like to call support groups for our builders, so that they can get together and go over best practices and figure out how to get through all of the issues we are facing as builders. These are some of the manufacturers that we are currently working with in builder partnerships. So if you are using any of these manufacturers, now's the best time to get started doing your rebates through us and starting getting a little extra cash into your business. And then we obviously have our consulting team that's here to help you. here's our seminar schedule. Our seminars upcoming in October. That's coming up pretty quick here. Superintendent and managing for profit. And then we'll also have a live version of production management, which we haven't had since before COVID. So this will be our first live one in a while. And then our online workshops that are available as well. So if you have any other questions, feel free to contact us. Our next webinar is in 2 weeks on October 19th with GAF Energy. They're going to talk about solar roofing, and that pretty much covers it. But you can
Jane,
contact- yes.
we're just posting the monthly charts that I put on the website.
Oh, yes.
And some of those will help them when they're talking to their trades. There are a couple that are very scary. But the last thing, I want to end on a positive note. This decade is the best decade for housing ever. And I wrote at the beginning of this decade, I wrote about a 36-page paper on how great the economy is. It would be a lot better if we didn't have the Democrats in charge. They really screwed it up. And we're right now probably almost a year into this downturn. I started talking about the downturn a year ago, that we were going to have it. That's it.
Okay.
Yeah, there's still plenty of demand, and there's going to be
A lot of
plenty of opportunities. So it's just let's run our business so that we can survive and take advantage of that.
A lot of demand. Well, there's a lot of need. Demand consists of three things. It consists of need, the desire, and the ability. And the federal government has taken away the desire because of the rising interest rates, and also the ability because we've disqualified so many people because of the interest rates.
Yeah. But those will come back.
They
Absolutely.
will.
They're
They will.
the problems are temporary.
Yep.
Yep. So feel free to contact Jim or myself if you have any questions. Jim is available at any time. You can reach him through his email at jim@shinconsulting.com, or you can call him at 303-810-1375 for any other questions. Thank you again so much for joining us today. We look forward to seeing you at many other events, and have a great day.